Welcome to Phil's Gang videos. I'm going to respond to the State of the Union address. It's absolutely ridiculous what they were saying. Example, let's listen to this.
With a growing economy, shrinking deficits, bustling industry, booming energy production. Today, thanks to a growing economy, the recovery is touching more and more lives.
S&P earnings have been hotter than a skillet, my friends.
The economic data continues to remain very good.
It is all nonsense. Now, what they have been saying, meaning CNBC, Bloomberg, any financial outlet, been telling us that earnings have been on fire, means profits, earnings, same thing, on fire, and they're at historic highs. We best know how they got there so that we can position ourselves in a market when this market collapses. And it will collapse 20-30% because of the way they got the earnings there by cheating. Let me explain how the market works. First, we know that the stock market goes up on earnings, okay, or profits. Earnings, you always hear earnings per share, or profits, same thing, okay? Not quite, but for the teaching purposes they are, okay? All right, so earnings per share and profits. That's what drives stock. Now, how does that happen? Well, you have 500 companies in the S&P. There's 500 S&P companies. So if you take the 500 companies, and let's just take one company over here. Let's take GE. And GE produces a jet engine. And when they produce that jet engine, okay, they sell that jet engine to a customer who pays them dollars. And after GE gets all these dollars, here's the dollars, they subtract all their expenses, right here, expenses, and what they have left are earnings, okay? And then you have these earnings, okay, or profits, earnings or profits, earnings per share, okay? So for every share you own, you reserve, you share into those profits, earnings per share. So what does that mean? That means if you got and here's your, let's say GE over here, let's say it has 10 million shares, okay? But out of that 10 million, what is available to the public is 5 million. So those are stocks you and I buy and sell. And those 5 million shares, every month we want to make sure we always have these earnings per share, and we check the profits of the company. We wait every a quarter to find out what are their earnings per share. So it's always a battle for good earnings. And earnings of this company is what moves their stock up from $10 up to 20 and so on. Okay, so their profits or earnings, so GE makes something, they take that, they sell it to a customer, they take the dollars, here are the dollars, they subtract their overhead, what's left is earnings or profits, and they take these profits and they share them. They share these profits among 5 million shareholders. Okay? All right, very simple. That's how, and the stock goes up. Now, what for a good economy, what do you need? Well, you need economic policies that are based on you want economic policies that give us productivity, production. Okay? So you want production, okay? There you are. You want production. Okay? And you want 100% production, you want 100% labor. So what does that mean? 100% production, 100% labor. Yeah, well, you got your building over here, your little building. And in that building, what we want is to make, here's our machine. And we got, let's say, 100 machines are in that building, and we have 100 people. That means we are at capacity. we are 100. We have 100 machines and 100 people. That means we are 100% labor and production capacity. And let's say we're building a jet engine. Here's a jet engine right here. Okay, and we sell these jet engines all over the world. And of course, that's how they make their money, and their money turns into earnings and so forth. We just talked about earnings per share. All right, now the key is that once you got up to the reason why the job of the Federal Reserve is to make sure that our companies are at 100% capacity, both production and manpower. That we can't fit any more machinery. We can't fit any more people. We're at capacity. Why? Because that jet engine right here, that jet engine, let's say they sell this jet engine right here. Let's say they usually sell it for $1,000, just for sake of argument. Well, because they cannot produce more, they're to capacity, and there's such demand, there's big demand for jet engines, then the customers start bidding up the price. So they bid up the price. They bid it up. So let's say it was 1,000. Now because such demand, they're saying, hey, I'm willing to pay more than that. Hey, I'm willing to pay more than that. So now it goes up to $1,500. Okay? So that is called, so that $500 extra is called inflation. That equals inflation, but good inflation. Why is it good inflation? It's good inflation because we have been able to keep in our factory over at GE 100 people working on 100 machines, and that means the economy is really growing. Okay? So now let's take and multiply. So this is all very good. That's a good economy right there. All right? Now let's multiply it times 500. So let's say these are 500 companies, all doing the same thing, all capacity. So that means now we total up all 500 companies, whatever they sold, refrigerators, engines, barbecues, whatever they sold, we add them all up, and that gives us what our GDP, here you go, GDP, our economic growth. Okay, so economic growth, what our growth is, okay? So we have our GDP, and that they add everything up, and then that equals our economic growth, and they give it a number. So if we're at 100% capacity, that means 7% is our GDP. We're at a 7% GDP, 7%. So GDP equals 7% because we're doing everything right. Everything is doing right. Everything's right. Okay, now that means the stock market of all these 500 companies will go up. And it will go up to a 200% gain. So they made a 200% gain if the GDP is 7% and everything's going well. And that's where we are today. But there's a problem. All right, here's our 200%. Here's our GDP over here, though. Here's our GDP, but our GDP is only up 3%. What? So how could you have profits way up here at 200% when you add up all the stuff of these 500 companies that are selling to people? It adds up to 3%. So that means our stock prices are going up, what? Whatever it is, 10 times, 20 times more than our economic growth. So our stock prices are growing faster than our economy. That's called a bubble. Those are called bubbles. So when you hear we're at 100%, I mean, when you hear how we're doing terrific like you just heard, this is what you're looking at. You're looking at a GDP of 3% with a stock market of 200%, when in fact the stock market on a GDP of 3%, okay, where we are, and I'm even giving them benefit, the stock market shouldn't be up at 200%. The stock market should be up at 100%. Okay, so that's 100% with a GDP equaling 3%. It's 200% GDP, 7%, so 7.1. There. Okay, so let's just quickly go through this. How does the stock market go up? Well, you have to have companies that produce. And when you have the right monetary policies and you're creating enough jobs, it's all about capacity, productivity, and labor. And you want to get as close to 100% in your factory. Every machine is working, and you got a person for every one of those machines, because the economic policies, okay, has created great jobs. And therefore, when all these companies build their stuff right here, and the demand is so incredible because the economy's so good and everybody's got money from working, that the price, because you can't produce any more stuff, then the price goes up from 1,000 up to 1,500. That's 500. That's called inflation, good inflation that we went from 1,000 to $1,500. This is all good. And our earning per share, okay, if we add up everything, the 500 companies, everything they sold, and we take all those profits and we put it together, we add it up, it gives us a GDP of 7%. It gives us a GDP of 7%, and it gives us that 7% will give us a stock market rally of 200%. But now our GDP is 3%. So how do we get up to 200%? How the hell did that happen without having all of this going on? In fact, what's really going on is this. Instead of 100 people operating the machines, the 100 machines, we got 10 people. Half the factory's closed, lights are out, you got 10 people. And over here, instead of $1,000 per unit, because there's no demand, the prices are going down. That's called deflation, down to $500. Why? Because when you don't have a strong employment base, you don't have a strong economy, then there's very little demand, and prices drop trying to find demand. How far do I drop my price before people come buy it? Well, what they do, people tend to hold off buying, and it gets worse. So instead of inflation, okay, right here, we don't have inflation, it turns into deflation. Okay, turns into deflation. So that means the price has dropped. That's deflation. Okay, deflation right here. So what's actually happened is prices have dropped. They're going deflation. We don't have very many people working. And when we add everything up that we sold, instead of 7%, they gave us 200%. We end up with 3%. So we end up with 3% instead. So here we go. So how do we get up to 200% a stock market move? With only if we add everything up we sold, it's only our economy's growing at 3% a year. It should be 200% should be at 7%. So how'd they do that? Well, so that they can tell you this kind of lies.
The economic data continues to remain very good. Earnings are exceptionally strong.
So how do they get them exceptionally strong when we don't have people buying stuff? And there's no demand, and we got deflation that you hear about all the time instead of inflation. The price dropped from 1,000 down to 500. So how did earnings per share or profits get way up here? They come up with an idea. And who came up with this idea? This dope right over here. These two dopes. Here's Bernanke. And then she comes in behind him right here. And he comes up with an idea of what we call QE. Now, what he says is, what we'll do is we'll push the stock market up, and let's take a look at it. Okay, the stock market, because we got deflation, prices are going down. There's only 10 people working. We're not at capacity. The stock market really, right now, should be right here at 100, right in half. Should be at 100%, half of where it is. So that's where, but he wants to move it up. So here's what Bernanke does. We'll cheat. We'll tell everybody we're going to do quantitative easing. It's going to help the economy. And we're going to help the economy recover, which is, it doesn't help the economy. Here's what it helps. So what he does is he takes his money, okay, and he prints it. So he prints his money. So he has a little machine over here printing his money. And that's the little printing machine right there. And he prints all this money. Now, how's he going to take, and he's got to get this money over here to push this up. So he's got to get this money from here over to here because they don't have profits, because companies don't have capacity. There's no demand. Remember, when you have a goods at $1,000, remember, we're saying this is this represents all 500 companies as an aggregate together instead of one company. If you don't have all these companies, and let's say if you add all up, they're selling products on average $1,000 each, but now they only can sell at $500 each, well, that means your earnings per share or profits are going to suffer, all right? Your profits got to suffer because you're not making much money. So to make the earnings per share go up instead of going down, they come in with QE. So here's what they do. Here's the earnings per share. So what they want to do is they want to move the earnings per share up because right now they're going down because of deflation. So they print money and they do, number one, they loan money to corporations. So they loan money to corporations at 0% so they can buy their shares. They buy their own shares right here. So if the shares are, let's say, 1 million shares every day, we're out there buying and selling 1 million shares. That's called a float because let's say the company has 2 million, but they keep 1 million, they don't trade. 1 million, they keep on the float. That's what we buy and sell. So the idea to move the earnings per share up or profits up without having sales to get us up this rest of the way here, they got to get it up the rest of the way here. Without sales, no top line sales, they got to fudge the profits and make the profits look better so that the stock of the price justifies it. So here's what they do. They decide you got 1 million, let's take and cut the 1 million in half. We'll cut it to 500,000 shares. Now what does that mean? Well, when the earnings per share come out, the profits come out, what's going to happen is there's going to be now fewer shares. Not 1 million, there's 500. So that means there's going to be, with fewer shares, fewer claims on the profits, on the earnings. So they're going to look better. And that's how the stock moves up. It's phony stuff. That's how they do it. So because there's 500 shares and you have less shares going, let's say you got 1 million shareholders. You got 500,000 shares. You've split that up to 1 million shareholders rather than 1 million. So by buying, using their own money, using their own dollars, the company using their own dollars, they get it from QE, they borrow at 0%, and they buy their own shares to drop it to 500,000. So that means their profits, when they share it with the shareholders, there's less shares and there's more shareholders. That means the earnings per share goes up without having sales. So over here, your earnings per share go up. Right here, earnings per share go up without having more sales. Because they want to remember, the market's up to 100%, but they want to get up to 200%. But remember, we have deflation because there's no demand because the capacity in our factories is at 10%, not 100%. So they got to fudge the profits to make it look better. So what they do is they form QE, prints money, so the corporation can buy their own shares and cut it to 500,000 shares instead of 1 million. And that means when the profits come out, they have less shares, more shareholders. See how it works? So you have less claims, okay, on the earnings of the company, and it makes those earnings or profits look better than they are to move the stock up. Now, what else do they do? Well, let's take a look at a company. Here's how a company works. Let's take a company. Here's a circle. And 50%, that would take 50% of the profits, okay, from the company, 50% of the profits over here. They're going to take and move them over here and do the same thing. They're going to go in and buy more shares and cut this in half, okay, to 250. So now you got less shares. So that means the stock price is going to go up even further now without having to do any sales. But also you got over here 37% of the profits you're going to give out as dividends. So these are dividends go to the folks that are investing in your company. 50% goes to buying. So 50% of your profits go into the company to buy shares, to drop the amount of shares down so you have a lot less shares and you have more stockholders but less shares to spread around. So that means the earnings per share increases without having sales. Now, there's a problem though. There's over here, we have 13% left to invest in the company. Over here, we're going to invest in the future. Are you crazy? There's not going to be much future. Now, why would they do that, only have 13% in the future? Because we're short-sighted. So here's what we got. This QE, they lied to us and said it was going to improve our economy. No, it wasn't. QE is only for one thing, to print money at 0% to give it to corporations to buy their own shares. Okay? And the second thing they do is here you have China. Let's take China right here. China has the yuan. There's their currency. Their currency is the yuan. They print a lot of yuan to buy dollars. And because because we spend $6 billion more a day than we take in, $6 billion more a day, China says to us, look, we'll take the dollars we just bought with our yuan and we'll dump that over to your treasury and we'll put it in your checkbook so you can pay your bills because you're spending more than you're taking in. So here's the checkbook right here. Put in a checkbook. All we want in return is interest. So let's say the yield or interest is going to be 4.5%. And then as long as we have a due date when you owe us, you know, the T-bill comes down the road, you know, it comes up, it has to be paid. So they give us a date, let's say 10 years or whatever. But they're happy getting the 4.5% interest. So the Treasury's happy because they're getting money and they can pay their bills. Well, soon what happened, they want to move the stock market. Let's say the stock market only moved up with all the stuff that's going on with the corporations taking 50% of their profits and moving the stock up. It's not quite enough. We only got up to this point right here. Not quite enough. So now they say, okay, well, we got to push this the rest of the way. How are we going to get up here? Well, what they'll do is now the Fed will come in. So here's Bernanke right here. Okay, so the Fed will come in over here and print money, print a lot of money. And then they'll print the money and they'll go in and they will buy the treasuries themselves. And they buy so much to drop the yield, the interest down to 1.8 where we are today. So now China, here comes China. They're right here to buy the treasuries. They look, they go, what? That's not a good return. So they say, well, instead, we'll go over to the stock market. So he played a nice trick on China. And then we go back up. That's how they get to the 200%. So the way the market goes up is through cheating. These earnings, they keep telling you they're cheating. They do it by printing money so corporations can take that money, buy their own shares back, cut the size amount of shares down so there is less shares at what they call float to spread these earnings around. And so therefore it goes up. The next thing they do is Bernanke prints more money, goes to buy the treasuries himself to make the 10-year treasury yield or interest on their money on attractive 1.8%. That little trick makes them come over here and put all their money 100% to 200% because there's no demand. Remember, there's no demand. 1% instead of 100%. That's where we are today. So that's how it works. So they just keep on lying about, hey, the earnings are terrific, but they don't explain how they get there. Now, what is the bottom line when they keep doing this? Well, you got to have QE keep doing this and doing this and doing this to keep pushing the market up higher and higher. Now, it gets at a point, though, that corporations owe so much money at 0%. They still owe it. They now owe so much, more than the cash they have. Now there becomes a problem. You only could do this for so long. And that's where we are today. So when this was going on, the stock market goes up like this. By doing the quantitative easing and lying to us, telling it was just to help the economy, it wasn't to help the economy, it was just to help the stock market go up and take care of the 10% people. So if you think about it, why, when the stock market was going up, it was to take care of the 10 percentile. Okay, take care of the 10% who are already in the market. They're making a fortune. So they're making an extra $650 million a year in profits. That's like Paulson and Soros and the rest of them. Now you would say, yeah, but now the president has a deal with them. I will artificially push the market up so you make an extra $650 million a year in the stock market, but I'm going to tax you so that I can, instead of creating jobs, I don't want to create jobs, because I'm trying to turn us into a socialist society. What I want to do is this. I'll give you 650 million extra by quantitative easing. And then what I'm going to do is I'm going to come tax you, and we take this tax money and I'm going to redistribute it to my social programs over here, to my welfare, and to my child care, and now I'm going to do free community college, and on and on and on. Now, the rich are happy because this is a bonus to them. So they're getting richer and richer. Well, what's the problem with all this? Well, the problem comes back to your capacity in your factory. How long can you survive when you have a factory where you got your machinery sitting here, right? And instead of having 100 workers over here, instead of having 100, you only have 10. Okay, so instead of 100, you got 10. So how long can this last? Because we're not increasing our jobs. We're not increasing our jobs. Our GDP remains at 3%, but our stock market going up 200% is acting as if it was a 7% GDP. So how long can you create this bubble between the stock market up 100% or up 200% instead of 100%? That's where we should be, at 3%. But we're up 200%. How long can you keep this up? This is called the bubble. Eventually what happens is that the factory not having this capacity and not increasing wages, then what happens is small businesses start to drop, because small businesses, remember, they create most of the jobs. So here's your small business right here. They create most of the jobs, 80% of all jobs. So if people don't have money, then the small businesses, they start laying people off, because remember, if you have deflation, remember what I told you, if you have only 10 people and you selling sneakers, right here's your sneakers, and you only got 10 people working instead of 100, then there's no demand for these sneakers. The price goes down because we don't have enough people working in our country, so prices go down and people wait till they get lower before they buy them, and that's called deflation. And like I say, you may be happy with gasoline or buying a pair of sneakers for less money, but when you go to work the next day, you're going to lose your job, because deflation equals joblessness. Okay? So the longer we play this game to try to get the stock market up, okay, here it goes up 100%, but to get it up the rest of the way to 200% right here by playing this 10% game, and remember the company's what's going on. So we don't have 100% productivity, we don't have 100% labor, and that means we get deflation, prices go down, and things get worse. The other thing we have a problem with at this point is that the job market just gets so bad that more and more people end up going on welfare. Okay? And so what Obama's trying to do is get more and more people, he wants us to have and get more and more people on welfare, because they become Democrat voters, because they depend on, they need food, they need all these welfare programs. So soon you're going to be the market will all of a sudden, when this QE stops, this 10%, when it stops, the market will pull back big time, because this QE is holding up, moving those market from 100 to 200%. And remember, the earnings per share, because they're buying back their own stock, the profits are being pushed up to justify the market going up the rest of the way, but it's phony. That's called the bubble. And when they stop this, it's over. Then the market collapses. So what does that mean in the meantime? A tremendous volatility in the market. The market used to go up like this, remember? The market was going up like this, because everybody knew with QE, hey, there was hardly any volatility. Nobody was really selling. We couldn't even get a 1.5% pullback, because then they knew this, what they were doing, the market was going to go up and up and up. And then we got to a point, all of a sudden it stopped, and we got this going. Now they're not so convinced anymore. Why? Because nobody quite believes anymore that the economy is good as he's saying.
The growing economy, shrinking deficits, bustling industry.
See, people don't believe that anymore. When they were believing it, the dollar was going up. And more people were dropping the euro. They got out of the euro, and they bought the dollar. I will, in my next class, explain how the dollar works. But at least now you understand how we get the earnings per share. We rig the earnings per share to move the stock market up. Instead of up 100%, we moved up an additional 100%, which means our stock market is overpriced by 100%, by 50%. And we know when that breaks, the QE stops, the market's going to drop at least half, give half back where it is. We're at 18,000, we're going to go down to 9,000. That's what's going to happen. In the meantime, we're going to have this great volatility in the market to make money. I hope you enjoyed this. Now you know better when they tell you earnings are historic highs, but now you know how they got there. They cheated because labor and everything else is historic low. See you on the charts.